today I would like to introduce you Hungary's approach when it comes to the implementation of the Basel III Accord, and hopefully at the end of this presentation we will see how it went so far in terms of strengthening bank capital requirements, also if it has improved risk management or financial stability in Hungary. Now let's see how compliance looks like in Hungary. You were all talking about this part, so I just want to state that Hungary, like any other EU member states, is obliged to comply with the Basel standards through EU legislation, and as you have previously mentioned, this has been done primarily through the Capital Requirements Directive and the Capital Requirements Regulation. Now, Hungarian banks are subject to these regulations, and this means that they must maintain higher capital buffers and they must meet stricter liquidity standards. Specifically, the Capital Requirements Directive was transposed into Hungarian national law through amendments to the Act on Credit Institutions and Financial Enterprises. Mostly we just refer to this as the Hungarian Banking Act, and this act incorporates various aspects of the Basel III rules, including, for example, capital adequacy requirements and liquidity provisions. So all in all, these legal instruments ensure that the Basel III standards are fully integrated into Hungary's legal framework. And let's not forget about the Hungarian National Bank, because the Hungarian Central Bank has a key role when it comes to ensuring that banks do comply with these capital adequacy requirements. Now let's move on. Here I listed some of the specific characteristics of the Hungarian financial system. I would like to talk about it very briefly just to give you some background context. For example, let's take foreign ownership first. As a fact, many of Hungary's banks are subsidiaries of foreign banks. You can see on the slide that nearby Hungary, I put some of the logos of the major banks that we find here in Hungary. Raiffeisen, Erste, Unicredit, these are just the major ones, but actually we touched upon this topic in your presentation, Xenia. So this is a characteristic feature when it comes to Hungary's financial system, and it definitely creates some additional complexity when it comes to the implementation of the Basel III standards, because this requires better and stronger coordination between the home and the host supervisors. Now, the second characteristic is the non-performing loans. Now, why is it crucial? It is because after the 2008 financial crisis, Hungary has reached a very high level of non-performing loans. Adam, you also mentioned that compared to the Czech Republic, we have a much higher level. As a consequence, it has been a key consideration for regulators in Hungary, and actually Basel III's stricter risk-weighted assets calculations take this into account, which is good because it pushes banks to reduce their exposure to high-risk loans. And the third characteristic is SME lending. Now, this is important because these small or medium-sized enterprises are crucial to Hungary's economy, and the Basel III regulations had to be balanced with the need to promote SME lending. Okay, let's see the pace of the incorporation. Three factors have influenced the speed of the incorporation. There was first of all the fact that we are member of the European Union, because the EU pushed for fast and consistent integration of the Basel III standards. So this has sped up the incorporation in Hungary as well. The second factor is political stability. By political stability here I mean that Hungary's political environment has been stable. There were no regime changes, so this has also facilitated the fast and smooth integration into the national framework. And the third factor is the economic context, because Hungary's need to maintain a stable banking sector, especially after the 2008 crisis, may have also pushed the government to adopt the Basel III regulations promptly to avoid further disruptions. So all in all, we can say that the implementation was fast and smooth here in Hungary as well. Now, a little bit about the supervisory authorities. The Hungarian National Bank is the primary supervisory authority. Its duties include monitoring banks' capital adequacy, liquidity, and risk management practices. Furthermore, it conducts stress tests to assess the resilience of banks under adverse economic conditions. And during crisis, the central bank uses macroprudential tools to ensure stability, such as counter-cyclical capital buffers and other protective measures. And let's not forget about the Hungarian Financial Supervisory Authority and other governmental institutions, because they all work together to codify the Basel III standards. And when it comes to the enforcement practices, we can say that the Hungarian National Bank has a so-called protective approach. This means that the central bank often intervenes when it sees that there are some kind of potential risks. And this was especially important during the 2020 COVID pandemic, when some additional supervisory measures were introduced to maintain the liquidity in the system. So as we know, the Basel III Accord has introduced a stricter capital requirement to strengthen banks' resilience. As you were talking about it, these provisions include common equity tier 1, additional tier 1, the capital conservation buffer, and the counter-cyclical buffer. Now, I don't really want to talk about it generally because you were talking about it. I just want to introduce you what's important from Hungary's perspective. When it comes to common equity tier 1, what we have to know is that common equity tier 1 in Hungarian banks is closely monitored by the central bank to ensure banks' stability and to protect depositors. And this is where the stress tests come into play and other supervisory activities to assess whether banks maintain the necessary common equity tier 1 levels. As for the additional tier 1, what we could observe is that the use of additional tier 1 capital instruments has been less common among smaller Hungarian banks due to their size and capital structure, but larger banks which operate in Hungary, for example OTP Bank, have issued additional tier 1 instruments to strengthen their capital base. As for the capital conservation buffer, in Hungary, such as in the rest of the EU, banks are required to hold 2.5% of their risk-weighted assets, CCB of 2.5% as their risk-weighted assets, which is composed of CET1 capital, Well, this buffer helps banks to absorb losses during downturns without breaching their minimum capital requirements. Of course, the central bank ensures that Hungarian banks meet this requirement and takes corrective measures if they fail to do so. And lastly, the counter-cyclical buffer. In Hungary, the central bank has generally kept the counter-cyclical buffer at 0% in recent years, reflecting relatively moderate credit growth and limited systemic risks. However, the central bank reviews the situation regularly and may adjust the buffer if it detects signs of excessive risk-taking or overheating in credit markets. And now let's move on to capital ratios, because under Basel III, capital ratios focus not only on the amount and quality of capital that banks hold, but also on ensuring their liquidity and funding stability. The Hungarian National Bank monitors the LCR to ensure banks can manage short-term liquidity shocks. The central bank has generally reported that banks in Hungary maintain adequate liquidity buffers, often above the 100% minimum requirement. Larger Hungarian banks like OTP Bank have been able to meet the LCR comfortably, while smaller banks are also able to comply, though the level of liquidity buffers varies depending on the size and risk exposure of individual institutions. And as an impact, we can say that the LCR has helped Hungarian banks to strengthen their liquidity management, particularly important in times of economic volatility, such as the COVID pandemic and related financial uncertainties. And as for the net stable funding ratio, it's been forced since 2021 after its gradual phase in across the EU. The central bank assesses banks' funding structures to ensure they are not overly reliant on short-term volatile funding sources. Again, larger banks in Hungary generally maintain NSFRs well above the regulatory minimum, reflecting their stable funding sources such as retail deposits. However, smaller institutions might have greater challenges in managing the bank balance between long-term assets and stable funding. And we can say that the introduction of the net stable funding ratio has encouraged Hungarian banks to focus more on securing long-term stable funding, reducing their reliance on short-term wholesale funding, which can be risky in times of financial stress. And as for the implementation of the leverage ratio in Hungary, we can say that most banks tend to maintain leverage ratios well above the 3% minimum, especially larger institutions like OTP Bank. This reflects the overall conservative capital structure in the Hungarian banking sector. Smaller banks also meet the requirement, although they might operate with slightly higher leverage due to different funding and risk profiles. And now let's talk a little bit about the challenges. Although I mentioned that generally speaking, the implementation of Basel III was rather smooth and fast, but there were and there are still some obstacles. For example, smaller banks and some financial institutions raised concerns about the costs and complexity of Basel III, and this included difficulty in raising capital or adjusting internal risk management systems to meet the new rules. There is also economic slowdown, because during economic downturns, if you enforce strict capital buffers, then that can lead to reduced lending by banks, which can slow down the economic recovery. this was a particular concern for the economy of Hungary when we were, for example, recovering from post-crisis. And at last but not least, there is the administrative burden, because the implementation has involved significant effort from banks and other regulatory bodies. It required special coordination and training. And now let's see the pros of the implementation and the remaining issues. There are definitely positive impacts, actually more positive impacts than negative ones or remaining issues, if I can put it that way. When it comes to financial stability, we can say that the implementation has contributed to a more resilient banking system, and by requiring higher capital reserves and liquidity coverage, Hungarian banks are now better equipped to combat potential economic shocks. And the regulations have also helped in preventing financial crisis by ensuring that banks are more careful now with their risk exposures. However, there are still some remaining issues, because it's true that Basel III helps address capital adequacy and liquidity concerns, but it doesn't necessarily solve all the structural challenges in Hungary's financial system, such as credit risk or issues related to non-performing loans. And now some concluding thoughts. Generally speaking, we can say that the implementation in Hungary has significantly strengthened the banking sector in general by improving capital buffers and liquidity management. So the banking system here definitely became more resilient to economic shocks, and stricter capital requirements, particularly for common equity tier 1, these have enhanced financial stability in general. The central bank has also ensured a smooth integration of the new standards. However, as I just mentioned, the challenges still remain, particularly for smaller banks. But despite these obstacles, I think I can say that Basel III has largely succeeded in safeguarding Hungary's financial system. And with this note, I would like to end my presentation. Thank you very much for your attention, and thank you very much again for coming, Ksenia, Adam, and Jędrzej, and thank you very much for your presentations as well.